Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Wednesday, May the 6th, 2026, and we're seeing some dramatic moves in commodities markets that are rippling across equities. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The dominant story shaking markets today is the sharp plunge in oil prices. Brent crude has fallen below the $100 mark, and oil futures dropped 8% on reports that the US and Iran are closing in on a deal to end the war. This is creating a massive relief rally across equities as investors price out recession risks tied to energy costs. What's particularly notable is how this is affecting sector rotation. Energy stocks are naturally under pressure, but we're seeing broad-based gains elsewhere as lower oil prices suggest reduced inflationary pressures and improved consumer spending power. The technology sector is particularly strong, with chip makers pushing both the Nasdaq and S&P 500 to fresh highs. However, there's an interesting divergence happening, where tech's rally is leaving some former leaders like Nvidia behind, while memory makers are becoming the hottest thing in the space. On the corporate earnings front, we're seeing solid beats that are driving individual stock performance. Disney popped 7% after beating Q2 revenue estimates, even with some softness in US park attendance. CBS blew past estimates and hiked its outlook after its insurance business outperformed expectations. AMD also soared on strong earnings results. The narrative here is that companies with strong execution are being rewarded, while the broader market is getting a tailwind from geopolitical de-escalation.
That oil move is certainly significant for the inflation outlook. How are you reading the market's interpretation of all these moving pieces?
Markets are clearly in risk-on mode right now, but I think there's some important nuance to consider. The oil price collapse is being treated as unambiguously positive, which makes sense on the surface. Lower energy costs mean lower input costs for businesses, more disposable income for consumers, and reduced pressure on central banks to maintain restrictive policy. However, traders need to watch whether this move is sustainable, or if we're seeing an overshoot based on optimism about a deal that hasn't been finalised yet. The speed of the 8% drop suggests some capitulation and forced liquidation, which can reverse quickly if the geopolitical situation doesn't improve as expected. What I find more structurally interesting is the rotation within technology. The fact that memory makers are outperforming while previous leaders lag suggests the market is hunting for value within the sector rather than just buying momentum. This is actually a healthier sign for the sustainability of the tech rally. The strong earnings beats from Disney, CVS, and AMD reinforce that we're not just seeing multiple expansion, but actual fundamental improvement. That combination of geopolitical relief, solid earnings, and sector rotation creates a more durable foundation than a single-factor rally.
What does this environment mean for traders looking at specific opportunities?
For active traders, the key is recognizing that we're in a momentum environment, but with selectivity becoming critical. The broad market rally off the oil news creates short-term opportunities, but the real alpha is in identifying which sectors and stocks benefit most from this new regime. Energy is obviously facing headwinds, so traders should be cautious about trying to catch falling knives there, unless you're looking at very oversold technical bounces. The consumer discretionary space becomes more interesting with lower gas prices putting money back in wallets. That's part of why Disney's beat is resonating. Healthcare, particularly the insurance side that's helping CVS, continues to show defensive growth characteristics. In technology, the shift toward memory makers and semiconductors broadly suggests that infrastructure plays are being favoured over consumer-facing tech. The chip sector's strength is tied to AI infrastructure build-out, which continues regardless of oil prices. From a risk management perspective, traders should be aware that we're seeing some warning signs too. One Wall Street bank is now flashing the first sell signal for stocks since 2021, suggesting the sugar high from recent gains may be fading. That doesn't mean you sell everything, but it does mean tightening stops and being more selective about new entries at these elevated levels.
Let's look at the major indices technically. What are you seeing in the charts?
Looking at the S&P 500, we're at fresh highs, which is technically bullish, but we're also entering overbought territory on several timeframes. The index is testing resistance levels that previously acted as ceilings, and we need to see follow-through buying with strong volume to confirm this breakout is legitimate rather than a false break. Support now sits around the 5,800 level, and as long as we hold above that on any pullbacks, the uptrend remains intact. The Nasdaq is showing even more strength, driven by those chip makers we discussed. The index has broken above its previous consolidation range, and the momentum is clearly positive. However, the divergence where some tech leaders are lagging creates internal weakness that could lead to choppiness. Key support for the Nasdaq is around 18,500, and resistance is limited now since we're in price discovery mode at these highs. The Dow Jones is participating in the rally, but lagging slightly compared to the other indices, which makes sense given its heavier weighting toward industrials and financials rather than technology. The Dow is approaching the 42,000 level, which is a psychological resistance point. What's important across all three indices is that we're seeing this rally on the back of both technical breakouts and fundamental catalysts with the oil decline and earnings beats. That's more sustainable than a purely technical move, but traders should watch for any signs of exhaustion, particularly if volume starts declining as prices push higher.
That selectivity is going to be key. Steve, let's get into the economic numbers. What's the picture looking like from the data side?
Thanks, Robert. Looking at where we stand this Wednesday in early May, the economic calendar has been relatively light this week, which is actually allowing markets to focus more on corporate earnings and geopolitical developments rather than being whipsawed by data releases. We did get some important reads last week that are still influencing sentiment. The April jobs report came in showing continued labor market resilience, though we're seeing some moderation from the extremely hot pace of earlier months. Initial jobless claims have been hovering in a range that suggests stability rather than deterioration, which supports the soft landing narrative that markets are embracing. On the inflation front, the most recent consumer price index data from last month showed some encouraging signs of disinflation, particularly in core measures, though energy prices had been a wild card before this week's oil collapse. Now with crude falling so sharply, we're likely to see that feed through into lower gasoline prices at the pump, which will help the headline CPI number in the coming months. This gives the Federal Reserve more flexibility in their policy stance. Looking ahead to the rest of May, we have some significant releases coming up. The next CPI report is due in about a week and a half, and that will be critical for understanding whether the disinflation trend is continuing or if we're seeing any reacceleration. We'll also get retail sales data later this month, which will show us how consumers are responding to the current environment. Producer price index numbers are also on deck, and those will be particularly interesting given the collapse in oil prices, since that feeds directly into input costs for manufacturers.
How should we be thinking about the Fed's position given all these cross-currents?
The Federal Reserve is in a much more comfortable position now than they were a few months ago. The combination of moderating inflation, a stable labor market, and now this dramatic decline in energy prices gives them optionality. At their last meeting, they maintained their patient stance, essentially saying they're data-dependent and not in a rush to adjust policy in either direction. The market had been pricing in potential rate cuts later this year, and this oil price decline actually increases the probability of that scenario. Lower energy costs reduce one of the key upside risks to inflation, which means the Fed can focus more on supporting growth and employment rather than fighting price pressures. However, it's important to note that the Fed will want to see sustained evidence that inflation is moving back toward their 2% target before making any moves. They've been clear that they don't want to ease too early and risk reigniting inflation. The economic data over the next several weeks will be crucial. If we see retail sales holding up, consumer confidence improving with lower gas prices, and inflation metrics continuing to decline, that creates the perfect environment for the Fed to signal a more dovish tilt at their June meeting. On the other hand, if growth data starts weakening too much, they might need to act sooner. The balance they're trying to strike is keeping the economy growing at a moderate pace while ensuring inflation stays contained, and right now the data is cooperating with that objective.
Let's shift to crypto markets. Lizzie, what are you seeing in digital assets?
The crypto market is in a really interesting phase right now, Robert. Bitcoin is showing cautiously bullish momentum after breaking through significant resistance at the $81,000 to $82,000 level. We've seen BTC surge above $82,000, driven partly by short liquidations that created a squeeze effect. The technical picture looks constructive, with long-term holders adding about 330,000 Bitcoin to their positions, which signals accumulation even at these elevated prices. However, there's a notable headwind developing from institutional selling pressure. MicroStrategy, which has been one of Bitcoin's biggest corporate champions, is signaling potential Bitcoin sales to fund dividend obligations after posting a $12.5 billion Q1 loss. Michael Saylor even mentioned they might sell to inoculate the market, which is a significant shift in rhetoric. This creates uncertainty, because if a major holder starts distributing, it can cap upside momentum. The Crypto Fear and Greed Index just turned neutral for the first time since January, which suggests the market is cooling off from extreme greed levels. Looking at the week ahead, Bitcoin could potentially test the $85,000 to $90,000 range if momentum continues, but I'd watch for resistance at that $90,000 psychological level. The CME is planning Bitcoin volatility futures, which indicates growing institutional hedging demand and suggests more sophisticated market structure is developing. For traders, the key support level to watch is the $78,000 to $80,000 range.
What about Ethereum and Solana? How are they positioned?
Ethereum is showing a more neutral to slightly bearish setup compared to Bitcoin. We're not seeing the same kind of momentum in ETH, and it's notably absent from the major rally headlines, which suggests it's underperforming. There's been some infrastructure drama, with KelpDAO migrating their RSF token to Chainlink CCIP amid disputes with Layer 0, which creates some uncertainty in the DeFi ecosystem. Ethereum tends to follow Bitcoin with some lag, so if BTC continues higher, ETH should eventually catch up, but right now it looks range-bound between $2,400 and $2,800. The lack of major catalysts is keeping it sideways. Solana, on the other hand, is showing the strongest fundamental momentum of the three. This is where things get exciting from a real utility perspective. Solana just announced a partnership with Google for Pay.sh, which is targeting AI payment infrastructure. This is significant because it positions Solana as the payment rails for what Lily Liu calls the AI machine economy. We're also seeing enterprise adoption with Forward Industries and RockawayX backing Henri to build on-chain reinsurance on Solana. Stablecoins are entering the AI payments ecosystem through this Google partnership, which gives Solana a genuine use case beyond speculation. The price action reflects this, with Sol looking bullish and potentially targeting the $180 to $220 range on continued adoption. For traders, Solana represents a growth play on AI and payments infrastructure, while Bitcoin is more of a macro hedge and Ethereum is in wait-and-see mode.
Thanks, Lizzie and Steve, for those insights. That wraps up today's Morning Bell. We've covered a lot of ground, from the oil price collapse and its market implications to the technical setup in equities, economic data positioning, and the evolving crypto landscape. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell so you don't miss our daily market analysis. We'll be back tomorrow with more insights to help you navigate these markets. Until then, trade carefully.